I'm Lee, librarian at the Mount Pleasant location of Providence Community Library. I just want to thank you for joining us tonight for the third presentation in our financial literacy series. Tax Smart Retirement Strategies is the title of tonight's presentation. It's offered through the Society of Financial Awareness, which is a nonprofit dedicated to providing financial education. The presenter, Michael Graff, has more than 35 years of experience in the financial services sector. He's an investment advisor representative, chartered tax advisor, and the author of the book, 6 Steps to Retirement. I ask that you just remain muted and without your video for the duration of the presentation, but please do feel free to enter any questions you have for Michael in the chat at any time, and he'll be able to answer all of them during the Q&A session. So Michael, the floor is yours.
All right, Lee, thank you very much. And welcome everyone to our presentation again, Tax Smart Retirement Strategies. Let's see, let me get my clicker going here. Okay, again, SOFA and the Providence Community Library sponsoring this event. Thank you very much. And again, not to go over my credentials again, but I am going to give people an opportunity to get a complimentary copy of my book. We'll discuss that towards the end of the workshop. And if you haven't already, you want to get a pen and a pad of paper just so you can jot down some notes, some questions. We're going to be together for, well, about 60 minutes this evening. And regarding questions, we're going to hold those till the end just so I can kind of get through the information as clearly as possible. So again, jot down your questions and I'll try to get to as many as I can at the end of the presentation. What we'll be talking about, we're going to start with a little bit of information on the Tax Cuts and Jobs Act of 2017. That's still relevant. We'll talk about how various retirement income and asset sources will be taxed during retirement. We'll talk about strategies to reduce taxes on retirement income and assets. And we'll talk about how you can go about preparing your own customized retirement tax plan. Very quickly, I just have to read this to you. I am in no way employed by or affiliated with or endorsed by the IRS or any other governmental agency. This presentation is not intended and should not be construed as tax advice. Please consult with an enrolled agent, CPA, or attorney before implementing any tax-related strategies, especially those discussed herein. All examples are hypothetical and for illustrative purposes only. Actual results may vary. No part of this presentation is intended to make an offer of any kind of financial or insurance product. Hope you like my little graphic there, that people are more interested in tax avoidance than maybe the meaning of life. Anyway, I like that. Okay, remember this old adage. It's not what you earn, it's what you keep. This is really what we're talking about. Like, you're going to earn money, you're going to accumulate money over your lifetime. The question is, how much are you going to keep and how much is Uncle Sam going to get? So we'll talk obviously more about that. We will start with basically understanding this premise that every dollar that you earn will get taxed. The questions we're going to explore are, when will that dollar or those dollars get taxed? In what sequence will they be taxed? And that's relative to the different income sources and asset sources that you will have accumulated and have available to you during retirement. And how does timing and sequencing impact how much tax you end up paying? By addressing these questions in a logical and organized manner, you will develop an efficient plan. And that's really what we're going for here. The bottom line is you have to pay taxes. The question is, how efficient is your plan from the standpoint of reducing the amount of tax that you ultimately pay? What are your retirement income resources? Well, here's a quick list. There may be more for some of you, but again, Social Security, pensions, all the way down to annuities and real estate. All of these, or some of these, may be available to you in retirement. Now, where most people get their retirement income from this is just kind of an average for people over age 65. About, well, 1/3 get their retirement income from Social Security, not a surprise there. Also, a lot of people opt to work during retirement. So about a third of income will come from wages. Then you'll have distributions from retirement accounts and investment accounts as well. Also pensions, that's going to make up somewhere between 15 and 20%. Then you'll have interest and dividends and other sources of income that are going to be about 10% plus. So again, just to give you kind of an idea of where the average over 65-year-old person will derive their retirement income from. Let's talk a little bit about the Tax Cuts and Jobs Act. Now, the main thing that occurred with this law change was the reduction of tax brackets. Now, they didn't go down a whole lot, but enough to save most people, the average person, a little bit of money. And you'll see here that, for example, the 15% bracket went down to 12, and you can read on the screen here what some of the other reductions were. The top bracket went down from 39.6 down to 37, based on the incomes that you see here. Also, another important change in this law was the standard deduction was actually increased and personal exemptions were eliminated. Again, we're not going to get into a lot of detail there, but just to point that out. Now, there were other areas where things were changed. We don't have time to get into any of that right now, and it's really not particularly relevant to our topic tonight. But the one thing that I do want to point out is that this law, the Tax Cuts and Jobs Act, does have what they refer to as a sunset or an expiration date, a sunset provision or expiration date, so that this law was really only applicable for tax years from 2018 through 2025, which means if nothing changes between now and 2025, then tax rates are definitely going to go back up. They're going to revert back to what they were. Now, whether there'll be changes between now and then, we can place bets on that, but just going, always plan based on what you know today, and then make changes based on what might change tomorrow. But what we know today is that the provisions will expire in 2025. So something to note in your planning process. Here's another version or another visual, if you will, on the tax brackets, again, from 10% up to 37%. But what I want to point out here is the two different types of tax rates. You have the effective tax rate, which is really the average of what you pay. It's the percentage of what you pay in tax based on the progressive nature of the tax rates. In other words, you pay 10% up to a certain amount depending on your filing status, and then the next bracket, 12, 22, et cetera. And then that gets averaged out. That is your effective tax rate. Then there's the marginal tax rate. This is really the tax bracket that the last taxable dollar falls into. Now, this is important from the standpoint of what you pay, and then, for example, when you get into things like you're going to be paying tax on certain types of things that, again, we're not going to get into right now. But the difference between marginal and effective tax rate will come into play during the preparation of your tax documents. Important to know. So here's an example. So a person or a couple who has taxable income at $80,000, their marginal tax rate would be 22%, where their effective tax rate would be 13%. All right, so how will your retirement income be taxed? Well, there are effectively three tax buckets. There's the taxable bucket. Now, things that fall in this category are things that are taxed in this particular or in a particular tax year. Things like gains on bank savings accounts, money markets, CDs, certain types of stocks, bonds and mutual funds, depending on how those are managed. But those, some things are taxed and gains are taxed on an annual basis. So they're taxed now. Then you have tax deferred accounts. We recognize these as, things like 401ks, IRAs, annuities and real estate have some aspect of tax deferral. So these are taxed at some point in the future, and that's something that we'll talk about. And as far as planning goes, this is where you end up doing a lot of your planning with tax deferred assets. Then there's the tax-free or tax-exempt bucket. Now, again, we recognize that things like Roth IRAs here, municipal bonds have some aspect of tax exemption. Life insurance, as long as the policy, a cash value policy, is structured properly, also can provide tax-free access or exemptions. Again, these assets are never taxed. There's also two income tax categories. There's ordinary income tax, and then you've got your capital gains taxes, both short and long term. So again, we see those tax brackets, and then we see the different types of funds or incomes that will fall into that ordinary tax category. Then you have your short-term capital gains, typically things that you invest in that you own for less than a year. Gains on those are taxed at ordinary income tax rates. But then when you talk about long-term capital gains rates, you've got three categories or three payment amounts. You've got 0, 15, and 20. And depending on your income and your filing status, you will pay between 0 and 20%. So again, when it comes to your planning, and this is where the effective tax rate, and this is actually where the marginal tax rate comes into play, depending on where your marginal tax rate is, will determine what rate you pay for capital gains. And again, the things that fall in this category are certain types of stocks, mutual funds, bonds, qualified dividends, and real estate. And again, there's obviously some variation on all of this, but again, just be familiar with it. Also want to point out that there's neither of these types of taxes are applied to, for example, Roth IRA distributions. Again, municipal bonds, again, you've got to look at that closely depending on your situation, the bonds that you own. And then also, again, life insurance, cash value policies, as long as they are properly structured, again, will give you some tax freedom. All right, the 4 phases of income taxation. So this goes to, again, every dollar is going to be taxed at some point. The question is, when is it going to be taxed and at what price? So the 4 phases are at the time of contribution, the time of, while it's being accumulated or while it's growing, at the time that you take money out, withdraw or take a distribution, and then transfer. Typically, this is during, an estate transfer upon a person's death, again, transfer. So at various times, it's either going to receive a tax favored status or it's going to be taxed in some way. So let's quickly look at how different types of assets are going to be taxed based on these phases of taxation. So for example, let's look at a traditional IRA, 401k, other types of tax deferred accounts. At the time of contribution, it receives a tax favored status because the money goes in without being taxed. Then during growth or accumulation, it's going to grow. So in other words, you're going to be receiving compound interest. You're going to be receiving interest or gains upon gains that you received in the past, which is going to be enhanced because you haven't reduced that amount by way of taxation. So again, tax favored status. However, at time of distribution or withdrawal, it's going to be taxed. And also at transfer, it's subject to taxation as well. Then you have the Roth IRA. Now, it's dollars that go into a Roth IRA are taxed before they go in, but then receive tax favored status going forward. So again, that's the advantage of the Roth IRA. Bank savings, CDs, money markets, that type of thing. Again, the dollar gets taxed before it goes in. Every year, you're going to pay tax on the gains. At the time that you take money out of these accounts, you don't get taxed at that point. But again, at transfer, it is subject to taxation, again, depending on estate planning, aspects. Annuities, and again, this is a non-qualified annuity, not an annuity that might exist inside, say, an IRA. This is a non-tax qualified annuity. The dollars are taxed before they go in. They receive tax favored status during growth. You don't pay tax at that point. You don't pay tax on the gains. But then during withdrawal and transfer, there are some things that can be both tax advantage as well as not tax advantage. Again, depending on the situation, something to go into in more detail with an advisor. And then there's life insurance. Again, the dollars go in already taxed, but then a properly structured life insurance policy will receive tax favored treatment going forward. All right, so where will your retirement income come from? Again, here's all the different places that you can derive retirement income and retirement cash from. So the question is, how will each be taxed? How will it be received? Now, what's really important to understand here is if you have multiple sources of retirement income, Social Security, a pension, distributions, maybe you've got money you're taking out of real estate in some form, who knows what, whatever it happens to be based on your situation. The question is, do you have a choice on how to structure the receipt or the distributions from the different sources? And if so, can you do that in a way that will enhance the tax advantage? Again, from a timing perspective, and frankly, from a sequencing perspective. Now, there's a basic rule of thumb. It doesn't apply in every situation, just a rule of thumb, that you should be taking money first out of taxable accounts, things that are taxed currently. Then the next place to take money out of would be tax deferred accounts. And then ultimately you would take money out of tax-free accounts. But again, I caution you that this does not, this is just a rule of thumb. You should look at your own situation and determine what would work best for you during your, retirement years. All right, so tax diversification and balance. Again, this really speaks to the three tax buckets. Again, tax diversification means being balanced between taxable and tax deferred assets and then tax-free assets. Again, important from a planning perspective. So again, how much money do you have in taxable and tax deferred assets against things that you have in tax exempt or tax-free assets? And this is really the struggle. Most people have money in taxable and tax deferred assets, but obviously the more you can have in tax-free assets, the better off you are. Again, something that we talked in depth about during a planning process, tax planning process. Again, how well tax balanced are you? Okay, so continuing with sort of tax diversification, there are two ways to accumulate assets for tax-free purposes. First of all, you can contribute money to a Roth IRA or to, say, a life insurance policy. You can also convert money. So there's contributing money and there's converting money. That's the two basic ways that you can create more tax-exempt or tax-free money. So here's an example. All right, so if somebody is properly tax balanced and they can take advantage of this in retirement, here's an example. Somebody, a married couple with a taxable income of $60,000, of which $10,000 is from a traditional IRA. Again, a very basic tax calculation here shows that they would have to pay in federal taxes a little over $6,800. However, if that same couple was able to take that $10,000, instead of taking it from a traditional IRA, they could take it from a Roth IRA, then it would reduce their tax burden by $1,200. So again, in this particular case, the couple had the opportunity, because they obviously had money in a Roth IRA, they were able to reduce their taxes because they were able to have some of their money be tax-free or from a tax-exempt account. All right, so there are two primary ways to save tax-free money. You can save money in, again, a Roth IRA, 401ks, also oftentimes offer Roth opportunities. Again, these are based on these are wage dollars, after-tax wage dollars. Again, you're paying tax on it before it goes in. Growth and distributions are tax-free. The downside is that contributions are limited. Without getting into all the details on that, if you're making a contribution to a Roth IRA, you have a limit. If you are making a contribution to a Roth 401k, it's a higher limit, but again, there is a limitation on that. There's also an income phase out. If you make too much money, then you can be phased out of a Roth contribution. Again, we can get into that offline. Also, there's no access to these funds until 59 and a half. They are retirement funds. So obviously you want to save them today and wait for retirement. Then there's life insurance. And I mentioned this because, again, this is a good tool for also creating tax-free availability of funds and income in retirement. The thing is here is that it's not necessarily based on wage dollars. You can actually put other types of dollars in life insurance. With a Roth, it's only wage dollars. Cash value is accessible by withdrawals up to the basis on the account, and also with policy loans. So again, again, a little bit more complicated with this type of a product. Generally allows larger contributions than a Roth account. Also, there's penalty-free access at any age. You're not restricted to the 59 and a half with this type of a product. Now, I want to just say something quickly about life insurance. First of all, there's a lot of people who don't like cash value life insurance. There are some people on the radio, for example, or some financial people, in the media who rail against cash value life insurance. And I'm not going to get into a discussion of that right now, other than to say that properly structured and in the hands of an advisor that understands how to use life insurance, it's an excellent tool for creating tax-free availability of funds during retirement and really during life in general. It's a good product. You just it's complicated, but you just want to make sure that you're working with somebody that understands how to use it. There are specific IRS codes that are specific to life insurance. So again, I'm not going to get into this right now, other than to say, don't just toss it out because you heard somebody on the radio say don't use it. It does have potential. Okay, so let's talk a little bit about Roth conversions. This is a big thing, and it's certainly something that if you have a lot of money in tax-deferred accounts, you should be thinking about. It's a process of transferring funds from a traditional tax-deferred account to a Roth account. At the time of conversion, however, you do have to pay tax. So that's an important caveat right there. You have to pay the tax before it can go into the Roth. And that may actually be to your advantage. It depends. There's a fairly, I won't say complicated analysis on this, but you do want to be careful how you proceed with a Roth conversion. It's not just a gimme. It's something that you really do need to sit down and analyze, and you really do need the assistance of a tax professional, a financial professional to help you with that. Here's a quick little discussion tree. Decision tree, I should say, that sort of helps to at least give you kind of an idea of whether or not you should even venture into this. Again, I'm not going to go through all the different bullet points here. I'm happy to discuss this with you offline. But again, just to let you know, there is kind of a quick little decision tree that you can look at, but it really does ultimately require a full analysis to determine if a Roth conversion can benefit you. All right, let's talk about Social Security and tax planning. There's something called provisional income. This is the sum of all income that the government uses to determine whether or not your Social Security will be taxed. Now, provisional income includes half of your Social Security income, wages if you're employed or self-employed. This also includes distributions from traditional tax-deferred accounts. Interest and dividend income is counted. Also, capital gains and pension payments are included. So if you are a single filer or a married filing jointly, if provisional income, say for a person filing single, if your provisional income is under $25,000, then none of your Social Security is taxed. If it's between 25 and 34, then up to 50% will be taxed. Over 34, then 85% of your Social Security will be taxed. The numbers are a little bit higher. Provisional income numbers are a little bit higher for married people. But ultimately, you can at least count on 15% of your Social Security never being taxed. Now, important to note here, excuse me, that Roth IRA withdrawals and also loans or withdrawals, certain types of withdrawals from cash value life insurance are not counted in provisional income. So the more you have in Roth or life insurance cash value, the more you may be able to do with planning to reduce or potentially even eliminate the amount that you pay in Social Security taxation. All right, required minimum distributions. Now, it used to be that after 70 and a half, you had to start taking money out. The government required that you had to take out at least a minimal amount. That went up to age 72. Actually, I heard recently that they're considering raising the RMD age up to 75, but that hasn't happened yet, and I'm not saying it will, but I just heard that. But in any case, here's the table. So just a quick example. Once you reach age 72, the example is $300,000 in tax-deferred accounts. Divide that number by the divisor at age 72, 25.6. That works out to be $11,719. one of the reasons that, or one of the things I want to say about required minimum distributions is that sometimes it makes sense to take money out of your tax deferred accounts before the RMD age, whether it's 72 or whatever it ends up being. Again, it's part of tax planning. The idea here is sometimes, especially with tax rates on the lower side now, due to the Tax Cuts and Jobs Act, it sometimes makes sense to take taxes early and actually volunteer to pay tax where you otherwise would not have to. I'm not saying that that's, what you should, every person should do that, but sometimes it makes sense to do that. But again, RMD, there is a point where the government says, okay, now you have to start taking money out early. Sometimes from a planning perspective, sometimes you want to take money out before the RMD age, something you talk to an advisor about based on your own situation. Okay, here's a kind of a history of the marginal tax brackets. So when the income tax was first initiated back in 1913, the highest bracket was 7%. Currently, the highest bracket is 37%. Now, as you can see in between there's been, tax rates were a lot higher. If you look, between say, late 30s, really into the 60s, 70s, 80s, the marginal tax rates were pretty high. What this says to me is that historically speaking, tax rates are pretty low right now, which means that tax rates probably have nowhere to go but up. And I say that really as not a warning, but just be aware that tax rates have more upside potential based on historical considerations than they do on the downside. And frankly, the way we are accumulating debt in this country and not bringing in as much income, especially because of COVID and business being down, there's a point where mathematically speaking, we're going to have to bring in more money. And some of that, probably all of that, to some degree is going to have to come from taxation. All right, so guess what, or guess who is going to pay all of those taxes, or a good portion of those taxes? It's going to be people with taxable income and people with taxable assets, like tax deferred accounts and things, which really means that you sort of have what I would sort of characterize as kind of a time bomb sitting inside your tax deferred accounts. What this really means is that at some point in the future, your IRA, 401k, 403bs, et cetera, you're going to have to pay tax on that money. The question is, you don't know exactly when, but you sort of know when. Certainly RMD, you kind of know when. But what you don't know is how much. You don't know what tax rates are going to be in the future. To some degree, there's predictability now. You know what tax rates are now. Should you pay some taxes now? This is where Roth conversions come in, and then just realize that later on you're going to benefit because tax rates are likely to be higher. Again, not saying absolutes, but just kind of my opinion. All right, want to just talk to you about the difference between taxable income and total income. All right, so what is total income? Well, it's income. It's all your income, from all these different sources. Everything from distributions to interest, wages, Social Security, etc. Taxable income is the portion of total income that is subject to taxation either by ordinary income tax or capital gains tax. So your tax planning objective is to reduce taxable retirement income in order to maximize total retirement income. Bottom line is, by reducing your taxes, we are going to be able to increase your income. It seems pretty basic, but I wanted to kind of sort of lay it out like that. Just lay it out so it's very plain. All right, just to kind of tone it down a little bit here, just a couple of little tidbits or quick quotes. The hardest thing in the world to understand is the income tax. Think about, you may know who said this. It's a quote from Albert Einstein, a guy who obviously thought about a lot of different things, complicated things. And one of the things he thought about was income tax. So he's no different than the rest of us in that area. Okay, in this world, nothing can be said to be certain except death and taxes. A quote from, we probably know this, from Benjamin Franklin. Here's another one I really like. Bill Murray The best way to teach your kids about taxes is by eating 30% of their ice cream. I like that. Anyway, okay, thought that was cute. All right, you may or may not know who this gentleman is, and I use that word loosely. This is Al Capone, who we probably know was a rather despicable character, did all kinds of bad things. But it's funny, the government could never get him on any of the terrible, terrible things he did. However, they did finally get him on income tax evasion. So it's okay. Hey, it's okay to avoid taxes, but you can't evade taxes. Anyway, okay. So let's move on here. Okay, so tax planning for retirement. It's really about following a process. Now, the process, I would like to spend all kinds of time this evening talking to you about the tax planning process, but I just don't have the time. But I do want to share with you, this is a one-page sheet that I put together, which really lays out what I see as the steps to take to put together a good, tax strategy for your retirement plan. So if you'd like to get a copy of this, just send me an email to sofawalpolema@gmail, and I will be happy to either mail you a copy if you want me to send it in the mail, or I can email you a PDF version of it. So again, and I think this will really help you in terms of understanding how to get started on putting together a customized plan based on your circumstances. Also, if you'd like to get a copy of my book, and I do talk about taxes in my book a little bit, just go to sixstepsbook.com. Just fill in the information, and I'll be happy to mail you a complimentary copy. Also, if you'd like to receive a weekly, I send out a weekly email. It's a weekly economic update, provides information on stock markets and economic issues and information. So it's a good thing. It's free. So if you'd like to get on my list here, it's sofawalpolema.com. At gmail.com. Happy to include you there. If you'd like to set up an appointment with me to talk about, things particular to you, I'll be happy to speak with you by phone, by Zoom, or even by in person. I have an office in Walpole, right off Route 1. Just go to meetingmike.com. It takes you right to my calendar. Okay, so the essential tax planning questions. Again, these are things that you want to be thinking about as you move forward with your retirement planning and tax planning. How much money do you have in each of those tax buckets? What's your tax balance? And is it balanced to provide optimal tax savings? If it's not, what are the steps you can start to take to bring better balance to your, to your buckets, to your to your funds? If tax rates increase in the future, do you have an idea of how much more you might pay? Again, we don't know what tax rates are going to do going forward. Again, I've given you my opinion. I think they're going up. How far they'll go up, we don't know. But again, if they go up, how could that potentially impact you? If you plan to leave a financial legacy, this is something that's important to a lot of people. How much of it will be taxable versus tax-free to your beneficiaries? And do you have a retirement income plan? And how well does it account for taxes and tax management? If you answered no, or I'm not sure to any of these questions, then you've got some planning to do, some tax planning to think about. So that concludes the presentation. Again, thank you to the Providence Community Library, certainly SOFA. So at this point, I'm going to go over to the chat and see if I can, let me see if I can pull up the chat here and see if there's any questions. Okay, try to go to the top here. Okay, is it true that alimony is not taxed? Yeah, okay, so the difference here is between alimony and child support. Actually, it's child support that is not taxed. Alimony is taxed. So yes, is it true that alimony is not taxed? Alimony is taxed. It's child support that's not taxed, okay? And that's something that is easily confused. And again, I used to do taxes. I used to prepare taxes a little bit. But again, I hope that clarifies that for you. Okay, is it true that it's not taxed? Okay, I got that one. Let's see, Iron. Okay, if you have any. Okay, never. Okay, that's from Lee. Hold on, I got to be better with that. Okay. Does one partner need to die to claim, I guess, life insurance? Okay, what's the benefit for a single? All right, well, yeah, I mean, it says LI here, so I assume that means life insurance. So yeah, I mean, whoever the insured person is, when that person passes away, then yeah, whoever their beneficiaries are, it could be wife, children, business partner, whatever. That person would receive the the benefits of that policy, the death benefit of that policy. The benefit of life insurance for a single person, paying final expenses, that type of thing. If a person is single, they don't necessarily need a lot of life insurance. Again, it can just be so that a person's final expenses like burial and maybe medical expenses could be covered, so that it doesn't become a burden to family or whatever. The other thing about life insurance, and again, I don't want to get into a lot of life insurance talk. That's not what this is about. But there's living benefits of life insurance policies now. In other words, it's possible with more modern policies to utilize the policy benefits or the face amount to cover things like illness, injury, terminal illness care, even chronic care, long-term care. So there's more modern life insurance policies have more options than just a basic, some of the older policies where you had to die in order for the people to get the benefit. But anyway, happy to talk about life insurance offline. Does Social Security get taxed differently based on the state you live in? Yes, it does. Let's see, in Massachusetts, Social Security is not taxed. The state doesn't tax it, but in Rhode Island, Social Security is taxed. And again, I always have to think about that a little bit because I have clients in a lot of different states, so I have to think about that. But yeah, Massachusetts does not tax Social Security. Rhode Island does. So yeah, so that is considered. Federally, it's the same for everybody, but obviously the state is different. Some states don't tax it, some do. Let's see, is there a limit on how much you can convert into a Roth? No, there's actually no limit. You have, in theory, if you have $1 million sitting in an IRA and you want to convert every dollar of that to a Roth, you can do that. There's a limit on the contribution you can make to a Roth, but there's no limit on the conversion from a traditional to a Roth. But understand that whatever you take out of your traditional IRA in that tax year, you have to pay tax on. So that would catapult you up into the highest possible tax bracket, in this case, 37%. That probably is not a good idea. So that's why when you're doing Roth conversions, you want to analyze it, and you really want to consider that on a year-to-year basis. Clients of mine that are doing Roth conversions, or that's part of their strategy or their planning, we look at that every fall, typically, sometime in the early to mid-fall, to say, hey, does it make sense to do a conversion this year? And then you kind of analyze it, because you're not locked into anything until you make the conversion. It used to be you could recharacterize them after you, if you made a mistake on a Roth conversion, you could sort of reverse it, but you can't do that anymore. So you want to get it right going in. But yeah, there's no limit on conversions. Limits on contributions, not conversions. Let's see. Okay, is there a limit on? Okay, got that. Okay, again, hold on. Let me just say. Okay, what bucket does rental income fall into? Okay, all right. So rental income. All right. So if you own real estate, it's a different type of a thing. It's a Schedule E item, and so what happens is you have the rental income, you have obviously expenses on real estate, depreciation, rental, all the stuff that goes on with that. So ultimately it's going to fall under, as far as rental income goes, it's going to fall under ordinary income tax, because it'll flow down to the bottom line on say your 1040. But if you're selling a piece of real estate, that's a different consideration. That would be, whatever gains you have, that would be considered long-term capital gains, assuming you owned it, for say more than a year. So it depends on, rental income would end up being ordinary income, ultimately. Let's see, I contribute to my 401k, not sure if it's better to contribute to a Roth. Well, look, you can certainly make an argument for contributing to traditional accounts, IRAs, 401ks, 403bs, et cetera. But you should look at Roth options. It may make all kinds of sense to be putting a bunch of money into a Roth. It may not. A lot of it depends on, look, if you contribute to an IRA traditional account, you get the tax benefit today. And that may be, you may need that today. That may be beneficial for you. If you contribute to a Roth, you don't get the benefit today, you get the benefit in the future. And that will be a benefit. Now, and to some degree, it may be more of a benefit in the future because tax rates are likely to be higher. In other words, if you pay tax today, in theory, you're paying tax at a lower rate, a lower tax rate or lower bracket. And in the future, you're going to be paying at a higher bracket. Another thing to think about is oftentimes when people retire, their income is lower. So therefore, they may fall into a lower bracket because of that. So the answer to the question is that you don't know until you sit down and do kind of an analysis and see what would work for you in particular. It works both ways depending on your circumstances. I'm in a 10% tax bracket, just inherited several $1,000s from land sales. Other than short-term capital gains, what do I need to consider? Well, if it's a true inheritance, all right. So it depends. If it's coming in cash, then it's not taxable. But if you're inheriting land, then you've got to step up in basis. There's a bunch of things to consider there. Other than short-term capital gains, that's something. It depends on how you received it. If you received it as property, that's going to change the dynamics. So something that I could answer better offline, or if you have an advisor, ask them. But it depends on what form you actually received it. Let's see. I think is that all? I think Lee do you know if those are all the questions?
I found there's one more.
Is there one more? Is
Yes.
it at the?
It may be easier for me to relay it at this
point.
point.
Go ahead.
Sure. Is a 1031 exchange / Starker exchange for real estate sales truly tax exempt?
Well, all right. So I am going to plead a little bit of ignorance here in that. All right. So I'm real good at 1035 exchanges. 1031. I'm familiar with 1031 exchanges, but I have to confess it is not an area that I have done a great deal of work on. This type of thing comes up very infrequently in my my financial practice. So I'm not going to be able to answer that question for you. I'm sorry. I could research it and get back to you if I know the circumstances better. Look, a 1031 exchange is designed to allow for the exchange of like property, real estate in this case, so that you are deferring the taxation to later. That's the concept. Now, whether or not it's actually going to be completely tax-free, I think to a large extent depends on the values of the two properties. But that's where I have to sort of stop with giving advice because, again, it's not an area that I've studied I really haven't studied it at all except very superficially. So I apologize. I can't help you with that one. Are there any other questions?
Another one showed up. Can you explain how to do a backdoor Roth?
Okay, all right. So here's what a backdoor Roth is. So let's say you can't contribute, to a Roth. You get phased out. You get phased out, or you want to contribute more than you're allowed to, just based on the contribution limit. Well, and actually, it's really more if you get phased out. So what you would do is you would then put the money into you would contribute to a traditional IRA. And then what you would do is you would then you would shift it over, or all right. So it works better for conversion. But then what happens is after you put it into the traditional account, then you do a conversion, because again, remember, conversions from traditional to Roth are not limited, whereas you have limitations on contributions. So conversions are not limited, whereas contributions are. So the backdoor Roth is where you are using a traditional deferred account in order to then move that money more quickly into a Roth, sort of getting around the income limitation. So again, it's more, it requires a little bit more complication, but that's essentially what it is. You're using a traditional IRA or a traditional account and then move that money over into the Roth account. So that's why they call it kind of a backdoor. Completely legal, but anyway. So, but again, I can give you more details on that and a better explanation of it offline. All right. Any other questions?
That's all we have.
Okay, great. Well, then again, I want to thank everybody for for being here this evening and listening in. And if I can help you further, please feel free to reach out.
Sounds good, Mike. Thank you for presenting these past 3 weeks.
Oh, it's been great.
All right.
All right.
Good night, everybody.
Thank you.